to the pools. Central New Mexico Community College, C&M, did redo their asset allocation with us and added an additional $15 million to their holdings. New Mexico Tech, which is our second largest client by asset size, they've got about $120 million in our pools. They're getting approval from their governing board to shift a small portion of their assets into the private market pools. They'll be the third client to kind of enter that area. We've just got a joint powers agreement that we're going to run by DFA and get them to approve first. Client assets as of the end of last month, $1.7 billion. Really, the growth here has been pretty remarkable if you look back even 10 years. So that's all I have, Steve.
Thanks, Charlie and Commissioner. That concludes my report. I'm happy to answer any questions.
Questions from council for the State Investment Officer. All right, if not, we're going to agenda item 2B. We'll turn it over to Mr. Smith.
Thank you very much, Madam Chair. Good morning, everyone. I'll be fairly short because we've got a fairly short agenda for you today. Just one new investment, and it's with a manager whose name I'm sure you recognize. So we look forward to that presentation and to see what you all think of that one. On the macro front, we are seeing the economy slow as expected. Here with just 2 days left in the third calendar quarter, the Atlanta Fed is expecting 3% annualized growth for the third quarter. That's down from over 7% earlier this year on an annualized basis. We expect that will continue, and we think we're headed for 1.5% to 2.5% rate of growth throughout next year. So continue slowing. We'll kind of take a glide path, it's like down to that 1.5% to 2.5% level that we saw pre-COVID. Inflation, though, continues to be sticky at these higher levels, and this is for a variety of reasons. And this higher levels of inflation may be with us for a while. There's still bottlenecks in the production system, shortages of parts and intermediate goods that are causing some price increases in good markets. Plus, businesses are finding it easier to raise prices generally in more of the consumer spaces. So we're keeping our eye on that. It's still not at levels that are concerning, assuming that it's going to be a fairly short period of time here. Around 3% on an annualized basis is maybe slightly a little bit more than that, for now. Yeah, hopefully coming back down later on next year. Headwinds to the markets are beginning to strengthen, and as you've seen, the stock market's flattened out here over the past couple of months. It's about August started to flatten out in the S&P 500 and the Russell 3000 here in the U.S. But those headwinds are starting to strengthen. We're seeing interest rates starting to rise. The 10-year Treasury's gotten above 1.5%, and looks as if it's going to head higher. The Fed's been talking extensively about curtailing some of the monthly bond purchases that they do. As you know, they purchase about $140 billion a month, about evenly spread between treasuries and mortgages. They've laid plans to start curtailing that. That's been a big liquidity provider for markets. And we're also starting to see, talk of higher taxes coming out of Congress. There's two bills now, and a few more on the fiscal side. That looks like the main focus is tax increases. So those things are headwinds for the market. We continue to keep our eye on those. So the picture started to change a little bit. We'll get into the performance report with RVK, and you'll see still very good performance over the past year, but this last quarter really starting to slow down, and we would expect that to continue. In your performance report, I just did want to mention one thing for when RVK gets there. You'll see that we are out of policy on the non-core fixed income. We're underweight by more than 500 basis points, which is our policy limit. Policy just states that on a best efforts basis, we get back within policy. There's no requirement to do it in any kind of time frame other than what's prudent and reasonable. We'd expect that probably to stick around a little while. I think it would take a correction in the stock market to get total assets down to where those non-core fixed income would slip back into that 500 basis points. We're getting capital drawn there, but it's a little bit of a slower process. Everywhere else, I think we're within bounds, and RVK will walk through that with you a little bit. Let's see. A couple of things that we're working on now. Cash continues to come in the door at very high rates. The land office's performance is outstanding, as you've been observing, and our private asset managers continue to return profits and contribute to capital at rates above what new capital is being called. So we're using the cash overlay manager that you approved several months ago in anticipation of this possibility, and we're underway in seeking further options to get that cash to work in the public or traded markets as we continue to get capital called into the private markets. A second presentation we're working on for you, or for October, is another look at our expected rate of return. We're now, with RVK's new expectations for the asset classes that we use and our asset mix, we're now below, on an expected basis, we're below 7% target, both on an arithmetic and a geometric calculation basis. So when that happens, it's usually time to review that number and bring it down. I won't foreshadow where we think we need to go, but it's materially lower than 7. A move like that would be consistent with what we're seeing our peers do. They're coming to the same realization, and RVK reports to me that the same number of their other clients starting to pull down their expectations into the 6s. So we'll have a full presentation for you on that next month. Matthias and myself and how we're working through, continuing to work through that. So I think that's what I have to report to you. Things are still going well on the new investment team, and you'll likely see a pickup in the number of investments later on this fall, back to sort of our normal 2 to 3 type of rate. So that's what I have for you, Madam Chair. Happy to answer any questions.
Great, Mr. Smith. We appreciate it. Any questions for the Chief Investment Officer at this time? And you all noticed Charlie did send us an email in response to Member Rawson's question about how far behind the #1 oil producer New Mexico is. All right, with that, we're going to turn it over to RVK, and I'm not sure if it's Martha or Matthias, but let's hear from RVK on the July 21 performance report.
Good morning, and today it's just Marcia. Matthias is visiting his family in Germany. Went home for a couple weeks. He hasn't seen them since pre-COVID, so I know he's having a great time. So I will be brief as well because this is older data and it's just a monthly flash that doesn't include an update on private investments. But just to set the stage from going backwards from what Vince was talking about, as of July, despite volatility in the market and global fears that the COVID-19 variant, the cases were increasing, and that called into question the sustainability of economic momentum. The broad U.S. market and the non-U.S. developed market gained in July, so we saw nice gains. On the other hand, small cap U.S. stocks had negative returns, as did emerging markets. Emerging markets saw a sharp decline because the Chinese government was focused on regulation, in particular in technology and private education. So mixed performance on equities for the month of July. The developed markets doing well. Bond yields in July declined. Concerns again with the Delta variant and signs that there were moderation in global growth caused investors to to want to move to safer investments. So in particular in the U.S., the 10-year Treasury fell from 1.45 to 1.22, and that was in the month of July. So as bond yields declined, prices rose. So you see that the Bloomberg U.S. Ag was up over 1% in the month of July. Also, in July, comments from the Fed noted progress in the economy and repeated that, as Vince said, at that point they talked about inflation, but they were talking about it was likely transitory. We're watching it very carefully. What does transitory mean? That means a few months, a few quarters, a couple of years. Just as you all know, we've seen an uptick in inflation. And commodities increased in the month of July, mainly in metals and energy components of the energy market. So July, mostly positive in equities, positive in the bond market, and positive in commodities. In August, it was global equities were up. Part of that was supported by the Fed chair speech in Jackson Hole at the Jackson Hole Symposium. And again, in August, the U.S. led the market. Unlike July, in August, global bond yields rose and commodities fell. We have preliminary number for August for your fund for the whole Mexico SIC fund, just under 1% for the month of August, but that's very preliminary at this time. So going through the report, I'm going to take you to first to page 20 of diligence. As Vince mentioned, on the top right-hand side, you can see a underweight relative to your policy and real returns, overweights in equities. We talked about that when we redid the allocation. This is reflective of the allocation changes to the land grant, to the severance, and to the early childhood. Performance is shown at the bottom. So for the month of July, the land grant was up 0.25. The severance was up 0.29, trailing the benchmark ever so slightly for the month, but calendar year to date, positive relative to the benchmark. Slightly and for the 1 year. Allocations are shown in more detail on page 5, as I mentioned, or page 21 of diligent. As I mentioned, this is reflective of the allocation change, and Vince has already spoken to you about the underweight and non-core and real return. We'll take you to the next page, page 22, just pointing out again that there was an allocation change to early childhood, and you see that staff has been working to implement that allocation and pretty close to the targets there. Page 23 looks at calendar year to date change in market values. In total, that's reflected and coming in from the commissioner's office, a net cash inflow in most of the funds. We understand the severance, it's net cash outflow, but money coming in and also nice investment gains on a calendar year-to-date basis for the land grant, close to $2.3 billion. Now I'm going to take you and just look at the composites. That's on page 26 of diligent. At the top, again, we see the total fund, and then broken down the land grants and severance, slight underperformance for the month. Looking at each of the individual composites, global equities, slight underperformance. There's been some, as we've talked about, some restructures there, so doing better. Some underperformance in the U.S. equity composite for the month, but in general, calendar year-to-date positive, and the degree to underperformance is much less than it had been. Structuring the portfolio have less tracking error. Non-U.S. equity was actually positive for the month, although negative in general. On a calendar year-to-date basis, trailing the benchmark. Core fixed income on the short term for the months, also slight trailing, having that short duration piece of the portfolio with a headwind for the month. You look at the longer time periods for your core fixed income, and you see nice outperformance. Non-core fixed income added to the portfolio some time ago, and it's been a nice diversifier for core. against core fixed income actually trailed trailed core for the month, but looking calendar year to date, having that non-core exposure was very additive to the portfolio. We have cash, and then on the following page, these are private investments and will be updated in your quarterly report. There is one section that is we're able to value, and that's the in real return, the financial real return composite that was down for the month, but strong performance for the calendar year to date to 25.74. That's a very small allocation. A lot of that is continues to be the MLPs, which has been volatile for you. With that, that's just an update for July. Happy to answer any questions.
Questions from council?
Madam Chair, this is Nick here. Nick Chase.
Member Taylor.
I just had a question on all of the information out on Evergreen and the financial sort of disaster that's been. In what way would that impact our SIC funds? If any?
Vince, did you have a direct exposure? I'm
sorry, I'm just getting off of mute here. I don't believe we do, but we can check member tests and let you know.
If anything, it would be quite small, I'm sure.
I mean, is there any kind of with respect to our real estate investments, is there any kind of exposure there? I'm guessing that we'd have to look at it and see it, but I just wonder what the fallout will be in terms of our investments, and it's probably more of a macro level global thing, but I'm just wondering if in particular any of our real estate will be impacted.
Member Tejas, this is Paul Chapman speaking. So we have very small exposure to Asia in general in our real estate portfolio, and then even less so in China. Most of what's being done in China is through one or two managers that are pursuing industrial strategies in China. So, and what we've heard from them is that where they invest in China, they're looking for strategies that are consistent with how the central government wants to see the economy directed, basically. So they view that building up the industrial sector, converting their industrial infrastructure to support a consumer economy is consistent with the direction of the central government. But to my knowledge, we're not invested in the residential sector at all.
Okay, thank you. Just had that.
Very good. Thank you, Member Tejas. Further questions? All right. Thank you very much, Marcia. We're going to move on to agenda item 3, which is our investment matters and our 3 voting items. I'll first turn it over to Chair of the Investment Committee, Member Lavender.
Thank you, Madam Vice Chair. The most remarkable thing about the meeting 2 weeks ago was that it lasted basically less than an hour. And, as you know, we're going to present for the council's approval John Elrich joining us as an advisor. And I want to make sure he doesn't think that that's a normal situation, because I think that's the first time in 11 years that the meeting lasted less than at least a couple of hours. We've got one investment to approve, a contract to approve, and as I said before, the approval of John Elrich. What I'd like to do is turn this over to Vince and to I believe that we'll start off. I believe it's Paul. So anyway, we had a good meeting, nice and short, and here we are today.
This is Paul Chapman. I can jump in here, Vince. Paul Chapman, Director of Real Estate and Real Return. I'm joined by Clay Camper and Nino Carpedito from my staff. We have Jack Koch, Seth Marcus, and Andrew Bradley from Townsend also on the line. And then later you'll hear from the team from Asana Partners, Terry Brown, Jason Tompkins, and Sam Judd. But before I get into the re-up into the Asana Partners Fund 3, I know that Jack Koch would like to make an announcement to the council. So Jack, are you there?
Yep, sure am. Good morning, everyone, and thanks, Paul. I wanted to let everybody know, and I've spoken previously with both Vince and with Paul and the rest of the team. Unfortunately, after 15 years with Townsend, I have decided to move in a different direction to something a little bit more entrepreneurial. So I will be departing the firm in a couple of weeks. Our relationship with you all dates back 10 years. So you just congratulated Vince on 11 years, and which is fantastic. And we were hired there right after, and I've been part of the team since that day. It is very bittersweet to say goodbye. I wish you all the best of luck. This portfolio has come a really long way since we first began working with you all, and something that I personally am very, very, very proud of. The team that you have now in place at the SIC, as well as with Townsend, is exceptional, and from my perspective, will continue to do just great things. So I do certainly appreciate you indulging me for a minute to say goodbye and to say thank you and to say I wish you all the very, very best. You are in great hands with Seth Marcus and Andrew Bradley, who have been part of the team for a very extended amount of time as well, know this portfolio inside and out. So with that, I'll go ahead and pass it back over to you, Paul, and I hope that our paths do continue to cross. As I will be staying in the real estate industry, just moving in a little bit different direction. So best of luck to everyone, and thank you very much.
Madam Chair, if I could say on behalf of the investment committee, Jack, it's been terrific having you on board. I think that each of us look forward to your participation on a regular basis, and we wish you only the best. Thank you for helping us manage the real estate in the way that we have, and wish you only the best. Sorry you're leaving, understand it, and good luck.
Well, thank you, Harold, very much. I appreciate that.
Thank you, Harold. Jack has been the lead partner on account, as he said, for 10 years. It's been an absolute privilege for me to work with him over the 5 years that I've been with the SIC, and he's been a steady hand on the tiller. And the results that we've achieved on our real estate portfolio in particular speak to Jack's thoughtfulness in guiding our portfolio. He'll really be missed, and I wish him great success in his new endeavor. Okay, today we are here to discuss a re-up with Asana Partners to their Fund 3. This is a closed-end value-added retail strategy, and we propose to commit up to $75 million to the strategy. The materials for this recommendation begin on page 48 of Diligent. Asana seeks to raise $1 billion for this fund, and the fund seeks net returns of 11 to 13%. Townsend has given this strategy a buy rating. You've heard me reiterate our strategy to underweight retail, and this underweight has contributed to our outperformance relative to our Odyssey benchmark. Green Street, a respected real estate research firm to which we subscribe, tracks mall and strip retail valuations. They estimate that retail mall valuations are down 13% from pre-COVID levels, but the downward trend in mall valuations predates COVID, as malls down roughly 50% from peak values in 2016, before the online shopping phenomenon really took hold. Looking at the two largest mall real estate investment trusts, Simon Property Group stock is down 40% from peak after being down by more than 75%. And Maestricht's stock is down about 80% from 2016 peak. The challenges facing U.S. malls has grabbed the headlines, but there have been bright lights in this gloomy sector. For instance, per Green Street, strip retail valuations, and these are generally grocery-anchored centers, are actually up 6% from pre-COVID levels and are nearly back to 2016 peak valuations. grocery sales increased as consumers stocked up and shifted to at-home dining. But Asana's retail strategy is quite differentiated from both mall and strip retail. Asana focuses on identifying dense, walkable, infill submarkets with high levels of income and education, buying a critical mass of assets in that submarket, and then adding to the portfolio with one-off acquisitions, leveraging their submarket dominance and connectivity to the retail tenant universe, and re-merchandising the submarket to achieve an optimal tenant mix of experiential and necessity retailers, such as boutiques, restaurants, and services that cannot easily be replicated by online shopping. Asana's strategy has proven out. Their 2017 Fund 1, which was substantially invested pre-COVID, shows a net IRR of 13.4%, which is quite compelling, especially compared to other retail sectors. Townsend points out that Asana signed over 150 leases during COVID, achieved rents 9% above underwriting. This is because many traditional mall tenants and digitally native tenants, such as Warby Parker, the eyeglass retailer, want to get closer to the authentic, walkable neighborhoods in which Asana invests. With that introduction, I'm going to turn it over to Seth, who will cover Townsend's underwriting of Asana Partners Fund 3.
Thanks, Paul, and good morning to all committee members. So as Paul mentioned, and I'll try not to, Paul did a great job of sort of summarizing their strategy, but I'll try not to repeat too much here. But we are presenting a $75 million follow-on commitment to Asana Partners 3. We are a similar, the same size investor, $75 million, of Asana Partners 1 and Fund 2. Those were 2016 and 2018 vintage vehicles, respectively. Before going into a couple additional specifics of the fund, I'll talk about the general portfolio construction. So throughout this year, 2021, we've committed and closed on approximately $466 million of closed-end non-core investments, span 6 different funds. Commitments were made across U.S. and Europe, and some broadly diversified strategies, as well as singular focused strategies, specifically industrial and the life science space. This resulted in about an overcommitment of in the 150 million range. However, this overcommitment was really planned and is not anticipated to impact our portfolio compliance or any impacts to our policy statements. Additionally, 3 of these 6 commitments that I mentioned were actually made in 2020, and we counted towards the 2021 allocation, given the closing dates and some of the fee discounts. So that too is the case here with Asana. If approved, we will target a first close in October, which will net us a 10 basis point fee savings. The other comment I wanted to make about the portfolio construction, and Paul brought it up briefly, is we've stressed in our quarterly updates that outperformance from the real estate portfolio is really the result of an overweight to industrial, multifamily, and some of the niche or other property types, and an underweight to both office and retail. Yet here we are recommending a retail strategy. So this group, and specifically Asana's strategy, has proven itself as resilient and really the future of what we believe brick and mortar retail, as well as a well-resourced and aligned team and group. Further, the Asana strategy has performed well prior to COVID, as mentioned by Paul's numbers, the returns in Fund 1, and really throughout the COVID pandemic, which I'm sure the team on the phone will talk a little bit more about. To reiterate the strategy and the positives that we believe are associated with the opportunity here, Asana historically, through its existing investments and really going forward, will acquire street retail properties in high growth, dense urban infill neighborhoods with really a favorable supply-demand characteristic. So these are walkable neighborhoods with a collection of small format spaces from boutique retail, showcase, service businesses, and restaurants. And Asana's value creation is through assembling and repositioning and really re-merchandising these properties into a mix of both national, regional, and local retailers, with the potential to aggregate a sub-portfolio, a combined portfolio exit. So this targeted strategy within retail has increasing tenant demand from retailers looking to really downsize their overall footprint, so smaller spaces. We're looking for more showcase space, adding the convenience of ordering online and picking up or returning and exchanging centers, and otherwise looking to really adjust to the e-commerce growth that we've experienced. Further, the space above the neighborhood retail is in increasing demand by businesses and retaining workers in functions where evolving connectivity enables working remotely or offering a low cost of living, no commute, 18-hour neighborhood settings. So despite the increased demand in this sector, these urban, near urban infill locations are often in historical settings. So this contributes to really high barriers to entry and limited new supply. There are a number of benefits to the fund that some of which Paul mentioned, but also are explained in our write-up. But the sector specialists, the experienced team, the ownership and alignment from the three individuals that you'll hear from today, the limited competition, really the performance that they've generated, and also the fee break. I'll just touch on the fee break. It's a little bit. There's a little bit of a nuance here in our materials, and there's a couple different things mentioned there. So these are meaningful. And like many funds, this fund starts with a base management fee of 1.5%. However, Asana offers discounts for first close, for loyalty, for aggregation, which will reduce our fee by about 25 basis points, which is obviously below market. On the potential issues, concerns, like all of our recommendations, this comes with few or a couple, although we believe these are very well mitigated. The key person risk identified in our recommendation is mitigated for a number of reasons. Really, the three founders that are on the call today are very strongly aligned from a financial standpoint. And when Fund 1 and 2 were really raising capital, this was a bigger concern. But the team is now fully built out with a strong group of both middle and senior team members across the firm. Additionally, there's a couple new markets that Fund 3 has the ability to invest in, and 20% of the equity can be invested outside of their target markets. Through past experience and conversations with the Asana team, this investment outside the target markets really is anticipated to be less than 10%. And further, the growing team now has more relationships, more expertise, and a broader group of markets, specifically on the West Coast, where we think there's some additional opportunities. I'll stop here, given the team is on the phone and giving them some time to present the opportunity, but happy to answer any questions either now or after their presentation.
All right, Paul, let's hear from Asana.
Okay, Terry, are you going to?
I am here, Paul, and thank you, Madam Chair. We're honored to be back with the New Mexico State Investment Council today. It's our third such visit. It's most unfortunate that we don't have the privilege to meet with you in person in Santa Fe as we did on our last two presentations. I think it's important that you do note that we have enjoyed and greatly appreciate our relationship with the New Mexico State Investment Council. And I would say that your team on the real estate side is one of the most engaged and interested investors we have. They're always interested in seeing their investments and call us as they're traveling in the ordinary course of business across the cities and neighborhoods in which we invest at Asana. Today, as with our prior presentations, I'm joined by the other co-founders and managing partners at Asana Partners, Jason Tompkins and Sam Judd. Moving to the presentation on page 2, I do want to highlight today that we're a vertically integrated platform and that we execute ourselves a specific value creation strategy for every investment that we make. We're not an allocator of our investors' capital to other real estate investors and operators. We do have senior leadership and deep experience across each of the functional disciplines listed on page 2, both in the operating and value creation category and the capital markets and risk management disciplines. We execute these with fully integrated real estate teams in Charlotte and Los Angeles, and with other offices in Atlanta, Denver, and Columbia. Moving to page 4. On page 4, you should primarily note a lot of organizational stability, with only a few strategic hires made since our Fund 2 presentation, and an increasing number of promotions from the organic growth of our business. As you might recall from our prior meetings, our most senior team is a core group of 8 executives who work together between 13 and 23 years across multiple platforms. Our team has strong gender diversity, and it has improving racial diversity. And our team's interest is very aligned economically across the entire organization. Most importantly, the team today is performing very well and achieving and excelling in the marketplace. Before turning the presentation to Sam, I do want to highlight just a few of the points on page 5 about the drivers of demand for the users of space in the neighborhoods in which we invest. Our retailers are doing well, and consumers are spending, and retailer sales are up, well above pre-pandemic levels. The retailers who are doing well are those retailers who have integrated platforms that operate both across e-commerce and brick and mortar physical stores. This is the model that works for retailers. Retailers and other users of space are looking for sophisticated landlords who own real estate in the most desirable neighborhoods. Neighborhoods that have definition and identity, neighborhoods that are convenient, open, walkable, and most importantly, those neighborhoods that live within an 18-hour ecosystem, mostly wrapped around living, working, services, shopping, and entertainment. So, Sam?
Thanks, Terry. All right, I'll talk for a moment about the investment strategy on page 6 and 7. So the investment strategy for Fund 3 will largely be the same as Fund 1 and Fund 2. We're going to continue to acquire undermanaged neighborhood mixed-use assets from local unsophisticated owners, and where typically the in-place rents are below market. Once we acquire these assets, we create value by investing capital into these properties. We physically change the assets, think new facades, new storefronts, hardscape, landscape. We change the merchandising mix. We bring new retailers through national relationships that we have, new service provider and office users as well. We assemble multiple properties in the same neighborhood. The larger a scale that we can control, the more we can positively change the neighborhood and create value for our investors. And while we don't typically underwrite this as part of our base underwriting, we look for densification opportunities in these existing neighborhoods where we can capitalize on the tenant demand and say, for example, turn a surface parking lot that we may control or a single-story building into a more dense piece of real estate. So just on page 8, here's a list of our target MSAs. We really target investment in the cities and neighborhoods with above average population density, above average population growth, above average educational attainment, above average cost of living adjusted average household income. And the neighborhoods, that we focus on are even, further above average. On page 9, some of the criteria by which we evaluate these investment opportunities, just a few points to discuss. Neighborhood identity is something that's important to us. Typically these neighborhoods may be defined by specific streets. They may have a name, like, in Santa Fe, the Rail Yard Arts District, or downtown, as an example. And we look for those types of neighborhoods in the cities we're focused on. We're very focused on walk scores, where people can accomplish all of their daily needs on foot. So really thinking about the people that live within 1 mile of our investments. We're very focused on ESG impact in our investments. When we buy and reposition these older, undermanaged buildings, we're saving them and investing capital and making them more energy efficient. So the strategy sets well there. And then, as I mentioned, we're always looking for the potential for non-underwritten upside where we can outperform our underwritten returns. Talking about the execution highlights on page 10, as you heard earlier, the investment strategy has performed well both prior to and during COVID. In Fund 1 and Fund 2, we've invested about $2.4 billion in 220 properties. We've executed 1.6 million square feet of leases. We've outperformed our underwritten rents consistently, including the leases that we signed during COVID. And I think that speaks to the demand by the tenants to be in these demographically driven neighborhoods. Both funds are meeting or exceeding our targeted fund level returns. And based on the realizations that we're starting to see in Fund 1 and the increasing tenant demand we see for our assets in Fund 1 and Fund 2, we'd expect to outperform the IRRs and equity multiples that you see at the bottom of page 10. Now I'll turn it over to Jason to provide an update on Fund 3.
Thanks, Sam. Turning to page 11, Fund 3's initial closing will take place on October 29th. We anticipate nearly a 100% re-up rate for our existing investors. Targeted returns and leverage are consistent with both Fund 1 and Fund 2, and our co-investment will be 1% up to $10 million. The carried interest structure is identical to Fund 2 and is typical for a value-add fund. Consistent with past funds, the majority of our employees will participate in the Fund 3 carried interest, creating strong economic alignment with our investors. The fund will have a 4-year investment period and a total 8-year term. We expect Fund 1, for example, to be fully liquidated by the end of next year, which would be 6 years into its 8-year term. Turning to page 12, I'll provide some concluding remarks, and then we'd be happy to open it up for questions. As Terry and Sam mentioned, our Fund 1 and Fund 2 investments have been resilient through COVID and are performing well. There is strong tenant demand for our spaces and strong institutional investor demand for our investments once we complete our redevelopment work. Our reforecast returns are based on conservative assumptions, and both portfolios set up nicely for outperformance. Fund 1 benefited from a clear first-mover advantage in the neighborhood mixed-use space. Fund 2 is also benefiting from more than 80% of its investments being COVID vintage. And Fund 3 will benefit from the Asana Partners vertically integrated platform, now having proven capabilities and relationships across markets. Our 78 professionals across our 5 office locations have deep experience executing on this strategy. Our multi-year investment sourcing effort has resulted in a robust pipeline of opportunities, and we believe Fund 3 will have the most compelling at-inception investment pipeline of any of our value-add funds. New Mexico State Investment Council made a $75 million commitment to both Fund 1 and Fund 2 and is one of our most important and engaged investors. We are honored to responsibly invest your capital, and we take our fiduciary duty to your beneficiaries very seriously. Thank you for considering an investment in Asana Partners Fund 3. Madam Chair, we are now available for questions.
Very good. So let's go to the council for questions on the Asana Partners 3 investment recommendation.
Well, this is Lee. I have a couple.
All right, Member Ross.
I kind of understand what you all are doing in the neighborhood, and that's a good plan. But there's a word in the document calls it authenticity of neighborhood, and all the presenters use various other words, which I understand in terms of what we're trying to accomplish. But I didn't understand the term authenticity of neighborhood, and I do understand the plan and the scope, but I just don't understand why we use the word authenticity of neighborhood. And I thought maybe somebody could just comment on that. Terry, can you take that?
Yes, I will take that.
On page 49 of the document.
Authentic, you would find that used across almost every document at Asana Partners to describe the neighborhoods that we invest in. I would say, first of all, authenticity implies that we're not creating the neighborhood, that a neighborhood has existed in most cases for a long time. I will give you just for an example, Larimer Square in Denver was an important acquisition of ours in last December. Larimer Square is largely a grouping of historic buildings with a few other buildings intertwined in an entire city block that's existed really dating back to the late 1800s. But there's an authenticity. The buildings have been changed, retaining a lot of the historic nature, but it's a place where the neighborhoods and communities have come together for years and years and years. That's just one example. We could give you similar examples, whether it's in the Brightleaf District in Durham, North Carolina. But generally, we're not creating neighborhoods. We don't do large-scale ground-up development. We are buying really existing inventory of buildings, many of which are historic buildings, and changing, reinventing those buildings and improving those buildings, as well as bringing in different and usually better users of those buildings.
Okay.
Member Ross,
yeah,
you might think of the downtown Santa Fe shopping area as being authentic, but you might think of the Santa Fe Mall as being unauthentic, right? It was sort of created instantaneously, whereas the Santa Fe shopping area came up, developed over years.
No, that's fine. I appreciate that. Thank you very much. Now, along that same line, as we focus, it seems like your focus is on historic buildings or buildings that are at least 50 years plus. So therefore, the question gets to be, we have a lot of code changes, we have a lot of TIs. Maybe you could comment on, besides the acquisition costs, it seems to me that there's a tremendous amount of TI expense. Maybe you can put that in some sort of scope in terms of percentages or how much you're involved in that or on the TI, or you just downstream a lot of that to the tenant.
Happy to cover that. So this is Sam. So, our team has got deep experience working in these historic neighborhoods. By way of example, we're the largest landlord of Newberry Street in Boston, Harvard Square. Terry mentioned Larimer Square, Abbott Kinney in Los Angeles, just to name a few. So we have a lot of experience in these neighborhoods. Typically, we're investing 20 to 25% of the acquisition purchase price and follow-on capital into these spaces. And in some instances, you're right, the initial capital is really to make some infrastructure improvements along with the physical aesthetic changes. You may be creating the electrical or the HVAC systems for those tenants. The good news is, the average space in our portfolio for both Fund 1 and Fund 2 is just under 3,000 square feet. So once we have a tenant in place, switching costs for tenants are very low relative to traditional bigger retail spaces. So, while there is some initial upfront costs that we underwrite to physically change these assets, once a tenant's in there, there are really not large TI dollars from that point forward.
What percent of the figure on the investment is in the actual building versus TI improvements?
On average, we invest 20 to 20% in total follow-on capital, including some first-generation TI spaces. But I don't have a percentage. Between the specific tenant improvements and the physical changes, but probably like
on average, we're putting probably a little over $100 a foot in aggregate kind of redevelopment and remerchandising capital into these assets. And, a third to a half of that would be the tenant improvement dollars, with the balance being kind of renovation dollars and some leasing commissions.
Okay. And then this, another crazy question on Townsend's report on page 52 or Townsend's page 5, I think. I'm a little confused with some of the location acronyms on the bottom. And I didn't know if at some point maybe we can label those a little bit better, or help me understand them at some point, but we can do that offline. The other thing I would like to have comments on is placement agents. And whenever we have an opportunity to come before us that uses placement agents because of the SIC's history, I think it's good to just vocalize what's going on there so that we can document it, and it's more matter of public record. So maybe just a couple comments later to Townsend or the sponsor on that.
Yeah, it's Paul here, Member Rawson. Evan always tightens this up in the side letter. There will be a prohibition from New Mexico State Investment Council paying for any costs related to Asana's use of a placement agent.
Thank you. That's all I've got, Madam Chair.
Thank you, Member Rawson.
And sorry, just so, Mr. Rawson, so on the acronyms, I'm just looking at the page. I believe you're referring to MSA, which is an abbreviation that we use for metropolitan area. And the Albuquerque MSA expands just beyond the city limits of Albuquerque and so on. So we can be more efficient with our acronyms there. Sorry about that.
Thank you.
Further questions?
Madam Chair, this is Tim. Can I follow up on that?
Mr. Treasurer.
Thank you. On your metropolitan statistical area, what is the percentage breakdown between that and the suburban areas outside your downtown area in your growth possibilities?
We do not invest in suburban areas. We typically target near urban and urban neighborhoods. So
really all of our investments would typically be within a few miles of the center city.
Madam Chair, if I could, on your page 9, on your fund size, I noticed that there's no cap yet. How large could this fund grow?
We do expect to upsize the fund, but we will not upsize the fund beyond $1.5 billion in size. We are currently deploying capital within this strategy at a pace of about $400 million of equity per annum, and this vehicle will have a 4-year investment period.
And on your page 10, where you have projected on your life of the fund under performance, can you tell me how is your projection based? How do you determine that?
The reforecast returns are based on actual experience through June 30th, 2021, married with projections from June 30th, 2021 through our projected disposition date for each asset. We utilize a software package called ARS, which reflects actual leasing terms, rents, lease terms, etc. And then we assign conservative exit cap rates to each of the assets on the disposition date to determine a residual value. And in Fund 1, for example, we're projecting that the majority of the assets would be disposed of over the next, 12 to 24 months or so.
Okay. Thank you. Thank you, Madam Chair.
Thank you, Mr. Treasurer. Further questions? All right, hearing none, do I have a motion to accept the recommendation for a investment to Asana Partners 3, and I believe it's a re-up?
So moved, Madam Chair. This is John Bingaman.
Sorry, Member Bingaman, you need to, I believe, read out the formal motion. Is that still the case? Yes. Do you have it there, Member Bingaman?
For council notes, that after extensive review, the investment committee unanimously recommends this investment. John, if you want to read out the motion, that'd be great.
Sure, I'll be happy to do that. I have it here. Based on recommendations of the Council Investment Committee, Real Estate Advisor, Townsend Group, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $75 million in Asana Partners 3, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
That is
I'll second that.
Proper
I'll
motion
second that.
by Member Bingaman and a second by Member Lavender. Discussion on the motion to approve the investment. Great. With that, we will have Andy call roll on Asana Partners 3.
Certainly. Commissioner Garcia-Richard.
Yes.
Secretary Romero. Yes. Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Messina, I believe you've joined the call.
Yes.
Mr. Tejas.
Yes.
Ms. Allen. Yes. Mr. Bingaman.
Yes.
Madam Chair, the motion passed unanimously.
Very good. Thank you very much to folks on the line from Asana. Next, we're going to go to agenda item 3C. I believe this is a contract for Green Market Research Services, and we'll turn it over to Mr. Camper.
All right. Thank you, Madam Chair, and good morning, council members. On page 98 of your materials, is a recommendation to current Green Street subscription process from individually renegotiating one-year subscription to instead implement what they call an Evergreen Amendment. As you may have gathered from Paul's quoting of some Green Street stats earlier in the meeting, Green Street is a very highly respected research firm that is heavily utilized by the internal research team, or real estate team, and then also just kind of broader real estate community. One example, the real estate structure study we presented to the council includes many data items that attribute to Green Street The Evergreen Amendment would simply provide the State Investment Council an opportunity to cancel the subscription if deemed appropriate.
Excuse me, Clay, this is Steve. You are cutting out on us quite a bit.
Thanks, Steve. Is this better?
Yes.
Okay. Thanks for letting me know. All right. So the Evergreen Amendment would still provide the State Investment Council an annual opportunity to cancel the subscription if we deemed appropriate. However, it basically just converts our one-off situations every year into a streamlined renewal process at a capped price increase that is lower than what they're typically requesting from us when we face current renegotiations of the contract on a year-by-year basis. I'll also note that the confidential annual price that would be noted at the bottom paragraph is actually less than the standard sticker price due to a discount we received on our first year's pricing. However, due to the new nature of the contract, which is effectively an auto renewal unless we decide to cancel it, Bart and Evan both recommended that we.
Well, I'm not sure what happened there.
Okay, Paul, would you continue?
Well, this all I'll say is that this is a very important market research vendor for us. Green Street, you heard me reference Green Street when I was talking about the Asana 3 re-up, and we use their research a lot. We used it a great deal when putting our structure study together, and we think we get good value for this contract.
All right. While we wait for Mr. Kemper to rejoin, are there questions?
This is Clay.
Are you back on, Clay?
No, this is Clay.
Apologies.
Oh, I'm sorry. Member Rawson has a question. Is that Clay?
This is Clay. I don't know what happened to my phone.
Okay. So I don't know if you wanted to complete your remarks, but Paul wrapped it up for you, and then we've got a question from Member Rawson.
Okay, perfect. Well, if Paul wrapped it up, we're good to go.
Member Rawson.
Okay, I guess my concern is I hate evergreen contracts. And I know where it saves staff some hassle, and I know that we negotiate a flat 4% increase on this. But the challenge is you've got to notify within a period on these evergreen contracts, and this one's got the 60-day notice. And I think it's a great asset to the state. I'm just concerned about the evergreen clause and what procedures does the SIC have in place to review this to make sure that we don't miss the timeliness if we decide that we want to cancel?
Sure. This is Clay, and then if anyone else wants to jump in, I'd say a couple things on the Evergreen Amendment. I think we're less doing it to make it streamlined and easy. That's an obvious benefit. I think a capped increase is a big one. They typically ask for more than that, and that in the event that they were frankly ever to be bought out or what have you from another company, we could see a much larger price increase, and so I think it's protective on that end. As far as annual renewal protection, I guess we utilize them very heavily and regularly, so we don't see the immediate need to change. We do get regular updates from Gordon in office, who is regularly pinging us well in advance of our contract renewals and making sure that it's something we continue to do, because his job is staying on top of kind of regular paperwork and filing and making sure that everything is aligned. So he historically has been really good coming in front of us well in advance of all of our subscriptions every year. letting us know that they're coming due and asking us if we still plan to present them going forward next year. So I guess that's our primary one we have at the moment, in addition to just checking in regularly with each other if we're still using things, because we don't want to keep using them if we're not. And a recent example would be Burgess, where we recently switched away from them, even though we had in place the ability to cancel anytime, but kind of a longer term duration set forward at the start of the contract, and we did implement that and get out earlier, simply because we had stopped utilizing the full spectrum of this service. So I don't know if that fully answers your question.
No, that helps. I just those things can get away from you pretty quick.
Member Austin, this is Paul. We could just calendar this, plan out, put it on our calendars, and we'll have the notice date on our calendars.
All right, thank you.
So do we need to make that change to anything we're voting on today, or is that just administrative?
That seems administrative to me, but it's up to the council.
Member Rawson, is that sufficient?
No, I got confidence that the staff will put something in place. I'm fine.
Okay.
All good, man.
Further questions on the Green Street Evergreen contract? All right, hearing none, I'm ready for motion. Do we have a motion to approve the contract?
This is Member Messina. I so move.
This is Member Lavender. Can you hear me?
I can now, yes.
Okay, I'll second that. I actually put the motion out. I'm not sure what was happening to the sound, but I'll second Mike's motion.
Would you mind reading that out, Member Lavender?
Sure. Based on the recommendations of the Council Investment Committee and SIC staff, I move that the State Investment Council approve a contract with Green Street Advisors as reviewed, discussed, and memorialized by the Council today.
All right, so that is a proper motion and a second. I believe the motion was made by Member Messina and seconded by Member Lavender. Any discussion on the motion? Hearing none, we'll have Andy call the roll on a motion to approve a Green Street Market Services Evergreen contract. Yes.
Secretary Romero. Yes. Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Messina.
Yes.
Mr. Tejas.
Yes.
Ms. Allen. Yes. Mr. Bingaman.
Yes.
Madam Chair, the motion passed unanimously.
Very good, thank you, Andy, and thank you to Clay for your presentation. Next, we're going to go to Member Lavender to present us with the appointment of Mr. Ulrich as the CIC advisory member. Member Lavender.
Thank you, Madam Chair. I think that we've had a terrific group of advisors over the course of time, Jean and Lynn, and we're thrilled that John is willing to step in and join us as an advisor. His experience is very well cataloged in the documents, within the documents, and I don't think there needs to be a significant amount of discussion. He's has a terrific experience, and therefore, based on the recommendations of the Council Investment Committee and SIC staff, I move the State Investment Council approve John Ulrich as a Council Investment Committee advisory member, as reviewed, discussed, and memorialized by the Council today.
I second that. This is Kathy.
Wonderful. Any discussion on that motion?
I do this after John on another nonprofit board, and he's terrific and a great asset to our to act as an advisor. So welcome, John.
Wonderful. Thank you, Member Allen.
Alan.
Further discussion? All right, so we've got a proper motion by Member Lavender, a second by Member Allen. Let's have Andy call the roll on a vote of the appointment of John Ulrich as a CIC advisory member.
Commissioner Garcia-Richard.
Yes.
Secretary Romero. Yes. Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Messina.
Yes.
Mr. Tejas.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion passes unanimously.
Great, and I'm not sure if Mr. Ulrich is on the line, but congratulations. And with that, we're going to move to agenda item 4 and hear from our Chief Financial Officer, Mr. Schiff.
Thank you, Madam Chair. I'm on page 105. Just a couple of things to point out. The budget to actual comparison that has been provided. I think it says in the materials fiscal year 21. It's actually fiscal year 22. That's a typo. But as I mentioned, I think last month, if there's any year that we potentially could have the need for a bar as it relates to the budget, it's probably going to be fiscal year 22. And that only is because the assets have really increased in value over the last year or so, given where we're at in the market. And then under item number 3, I did want to point out, and I have a draft, and we're in the process of finalizing the agreed upon procedures report for the fourth quarter of fiscal year 21. That should be going out to everybody, council members and advisory members, by the deadline, which is September 30th, which is Thursday. I expect to get in the final copy here fairly shortly, and I'll forward that out. And then I did want to point out for the appropriation request for fiscal year 23, we did meet the deadline for that, which was September 1st. I don't remember if Steve pointed this out. I did want to mention we were notified recently that we have a new Lfc Analyst. Don Iglesias moved to another position within the state. Our new analyst is Izzy Torres, and Charlie and I will be meeting with him on Thursday to kind of go over some preliminary discussions on our appropriation request. Other than that, everybody could turn to page 149. I know Member Tejas asked, I think it was last meeting, about a little bit of a discussion on this fund balance and income distribution report, which I have been including for some time in the material. And if you go to the last column of that report for August, you'll see the $24.3 billion. And then up above that, you have all the beneficiaries within the land grant permanent fund. And occasionally I get questions on this, and I know, Madam Chair, you and your staff asked some questions about this when you were first in office. So I just had to go back and look at some of my material there. But, you know, to give everybody kind of a rundown of how this works, I think everybody understands for the land grant permanent fund that the distribution calculation at the beginning of the fiscal year is a 5-year average of the ending asset values for the previous calendar year. For instance, fiscal year 22 that we're in would have taken the calendar year NAVs for calendar year 20, 19, 18, 17, and 16, does a average of that, and then calculates 5% of that. And that's going to be the total distribution for the fiscal year. 1/12 of that distribution is distributed on a monthly basis. So, it's a pretty easy calculation. I think next year when I do calendar year calculation, so everybody kind of sees how that is done, I'll provide that to everybody. But 1/12 of the total distribution for the year is distributed monthly. If you look at the beneficiaries, the common schools has the majority, over 86%, as of the beginning of August, of the total ownership in the fund, and you can go down and see all the other participants within the land grant permanent fund. The land transfer that comes in from the land office every month is designated to go to the individual beneficiaries. We did not decide that. So if you look at that land transfer, that's the column that basically we don't have any determination. That's the information is provided to us. All the other columns that you see, the capital gain, the unrealized capital gain, the income, all the allocation to the individual beneficiaries are based upon the percentage of the fund at the beginning of the month, which you have all those percentages. And the only percentages that would change are the result of that transfer that comes in from the land office. For instance, for the land transfer coming in for August, if that percentage for the common schools, that top line, is greater than 86% of the total, which is their ownership percentage, let's say it came in at 90% of the total for the month, then that beginning percentage that you have, percentage of the fund, will change going into the next month. So it's all that we're doing on a monthly basis is recording those transfers, and then based upon the percentages at the beginning of the month, allocating all those other columns, and then that rolls forward into the new ownership percentages at the end of the month. And with that, that's all I have, unless there's questions. Member Tess, does that make sense to you? Do you have any questions, or do any other members have questions on that?
Yeah, Madam Chair, I do.
Okay, go ahead.
Yeah, so is the percentage of the fund set in statute somewhere?
Well, remember, Tab, the percentage of the fund is really the percentage that have developed from the kind of start of time. Okay, so based upon the assignment of these trust lands to the beneficiaries and the monies that have come in and the earnings that have happened, based upon that assignment to the individual beneficiaries, the common schools have developed over time an ownership percentage of over 86%. They get the vast, and that's where the common schools, they get the vast majority of that. Every month, the transfer from the land office comes in, and based upon that total division by beneficiaries, it can tweak that ownership percentage going into the end of the month, but it's kind of a developed percentage. It's not set in statute. It's kind of, I guess you could say it's set in, the lands are assigned to the beneficiaries, but the 86% kind of reflects, what's come in from the land office since the beginning of the time, as well as what's developed in terms of earnings from their investments. So, Charlie, based on the vote that we're going to have in November about increased distributions to the beneficiaries, the question came up, well, what happens if the common schools get a larger percentage than 5% and the other beneficiaries only continue to get the 5%? Well, the common schools, if they're getting more than everybody else, their ownership percentages over time will tick down because they're taking more than everybody else. But because they have such a large ownership percentage to start with. It's probably going to take years and years for that to go down even below 80% based upon my analysis. But, you know, as I said before, the percentages that you're seeing there are what have developed over time for the beneficiaries of the Land Grant Permanent Fund.
Great. And then I
just wanted to offer that if you'd like any further detail from the accounting office, you know, here at the land office, our folks have been, you know, doing these distributions for years, and they can answer very specific questions, and they have for the CFOs of our beneficiaries, for legislators. So I'd just like to offer that to you.
Oh, thank you very much. I'm going to take you up on that for sure. The only other thing is the income earnings column is negative. Can you explain that?
Oh, yeah. Hold on just a second. Unrealized gain or loss. That's telling me for the month that there was some negative earnings. The capital gains and losses. Hold on just a second. Let me get my thoughts on this. From what I'm seeing here on this is that there was some negative adjustments, and I think some of this probably relates to some of the fee adjustments. We passed through some fees for the month, and because of that, you would normally expect a positive in that column, but because of the fees that were allocated to the Land Grant Permanent Fund, it's negative a month.
Gotcha. Okay, that makes sense. And yeah, that's all I have. Thank you.
Okay, and member Taz or any of the other members, if you have any follow-up questions on this schedule in particular, or any of the schedules that are provided, we are happy to provide any additional information that you might need to clarify. I know in the past I've met with the vice chair and her staff. Yeah, they had some questions, and within 30 minutes or an hour meeting and discussing and going over any fine questions that they had, fine detailed questions. I think they got all their answers, answered, or their questions answered, and we're happy to do that with anybody that has questions on this schedule or any of the other schedules that we have. And Madam Chair, that's all I have, unless there's any follow-up questions on any of the material provided.
Further questions from council from Mr. Shipp? All right, we're going to head into agenda item 5A. Any old or new business before the council?
Well, Madam Chair, I just wanted to add that, you know, this is kind of a day of talking about anniversaries. I know that we just hit Vince's 11th. This meeting marks my 10 years. I've been a member of the council now for 10 years. And of all the things I've gotten to do since returning to New Mexico from Chicago, this is by far the most rewarding and the most enjoyable. So 10 years it seems like a long time, but it sure did go fast.
Very good. Congratulations, Member Lavender. All right, I'll announce that the next meeting of the SIC will be held, I believe, telephonically on Tuesday, October 26th. If that changes, we will hear from staff. And with that, we will move to public comment, agenda item 6. Charlie, do we have public comment?
Madam Chair, we do not have any public comment submitted today.
Okay. I will take a motion for adjournment in that case.
But could I ask that the meeting notice be sent out? I'm sorry, and thank you, Stephanie, for getting the information to me. I could not find the email for the link, and so the day of the meeting or the day before, if we could get again the reminder and the phone call, the telephone number for the meeting, I'd appreciate it.
All right. Yes, that's a request. I think can it be accommodated by staff, Steve?
Of course, and Andy has already come up with something for each member of the council, which she will be sending out to you that you can just post nearby your computer or wherever it's convenient, so you'll have these numbers at hand.
Okay, and then the other thing is, could you send by email the dates, proposed dates for next year? I know that they were in the board book, but it's easier to compare in a calendar if we can print it out. And so could you send by email?
Happy to do that.
Yeah.
All right.
Thank you.
And member Al, I also wanted to comment. I think you had a follow-up question for our IT department, and I know we've been a little understaffed. And I just wanted to let you know, we will get you a response to that. We'll make sure to include that to the rest of the council as well. But just be patient. We'll get you a response.
I appreciate that. I understand. Thank you.
Great. Any further old or new business? Do I have a motion for adjournment?
So move.
All right. We have a motion by Member Lavender. I don't know if we need a second. Okay, we've got a second. Any objection to the motion to adjourn? Hearing none, we are adjourned. Thank you, folks.
Thank you very
We'll
much.
see everybody. Thank you.
Thank you all.